Hello, everyone, and welcome to the Dorsey and Whitney ACA reporting webinar. Today we have a session on tackling complex Form 1095-C situations and preparing Form 1094-C. My name is Tim Goodman, and with my colleagues, I'm going to ask them to each briefly introduce themselves. And I'm going to go ahead and start with Liz Beckman, a colleague of ours who's in Seattle who's participating. Liz, would you like to tell everyone about yourself, please?
Oh, hi, I'm Liz Beckman. I'm in the Seattle office of Dorsey and Whitney, and I practice in both doing defined benefit plans and 401k plans, but also health and welfare plans, which seems to be a very exciting area of the law right now.
Thanks, Liz. Bob?
Hi, my name is Bob Singh. I'm in the Minneapolis office at Dorsey and Whitney. I started my life as a lawyer with the firm a long time ago. I worked here for 12 years. Then was inside with Target Corporation. I like to tell people I went and took a job at a place whose theme was expect more, pay less, and was there for about a dozen years, and happily was fairly involved at the federal level on some of the rulemaking under ACA, and am now back in private practice kind of watching how that's all affecting many of you today.
Hi, my name is Lindsay Docto, and I am a new associate in the Benefits and Compensation Group in the Minneapolis office, trying to learn both the health and welfare and retirement sides.
And Lindsay's being modest because she's very knowledgeable, and during her law school career, she worked on ACA things, so that's been great to have her with us here. With that brief background, we're going to dive in here and just start going through our slides. I should briefly mention, if you have questions as we're going along, the way that we're getting questions and responding to questions is to have them sent to Lindsay's email address, which I believe you should have in your materials, but is docto, D-O-C-T-O, .lindsay, L-I-N-D-S-A-Y, @dorsey.com. So do feel free to ask questions, and we'll proceed through the questions as we receive them. What we're going to do is have Lindsay read them, and then either Liz or Bob or I will work on responding to them, and Lindsay as well. So here we are, and we're going to start on slide 3 here with Forms 1094 and 1095 and a brief overview just to give people some background. With respect to this, there's really 2 sections of the code which are driving this reporting, Section 6055 and 6056. And you can think of this as both the individual mandate and the employer shared responsibility fee. Those forms are things that we have so that we can tell the IRS who has coverage and how many employees are being covered, so the IRS can determine whether it needs to assess fees with respect to individuals or employers. So by way of example, if an employer has more than 50 full-time employee equivalents and has a self-insured plan, the Form 1095-C has 3 parts that it would complete. Part 1 is the general information about the employee and the employer. Part 2 is lines 14 through 16, which we'll be addressing throughout the discussion here today, and that tells us about who was offered coverage and what type of employee they were and information like that. And then Part 3 is for the actual individuals covered. That goes to that individual mandate. And again, if an employer has an insured health plan, the employer is still doing a 1095-C, but they wouldn't complete that Part 3, and instead the insurance company would provide a 1095-B for that employee. With both 1095-Bs and 1095-Cs, the IRS has a header or batching form that's a 1094, and that's used to give the IRS some additional information about all the 1095-Cs that each employer is filing. And we're going to go through that more towards the end of the presentation. First, we're going to get into some of the more complex situations that arise with respect to the 1095-C.
And Tim, just by way of sort of sequencing, with the IRS delay in the deadline, we have a deadline for the 1095s that's a little bit off yet, and then even later is the 1094 filing, right?
Exactly. The IRS, and this is one of the materials that was sent around in Notice 2016-4, extended the period for filing this year for both the 1095s and 1094s. So the 1095s were actually pushed off to the end of March in essence. And the 1094s, generally, if you're electronically filing, are now the end of May, in essence, in terms of the timeline for filing these.
And it's safe to say, I think we're just a teeny-weeny bit surprised that even though we have relief on these 1095s, many employers are getting them out. And what I'm hearing, and I think you have told me the same, is that employers want to get them out really to avoid having to answer a bunch of questions from their employees.
Yes.
Okay.
And so, you know, some employers, the extension only came at the end of December. So by then, many employers had already geared up or been working for the year to really get these things done. And while the extension is definitely welcome, I think a lot of employers, if they were on target to get them out at the end of January, they might be giving a slight pause, a week or two, but they're still trying to get them out early and not take too big an advantage of the extension, I think.
And maybe in that vein, just one more sort of setting the table and piece of advice. There may be a few moments today where some employers say, oh my God, I did something wrong on line 14, I've got to go reprogram and delay a month. And I think what I'm saying, and I think we're probably Liz and Tim and Lindsay and I are on the same page here, there are more than one way to slice a lot of these answers. So don't panic if during this next hour and a half you think you've done something terribly wrong on your 1095s.
Yes. Yes. All righty. With that, we're going to start in a little bit with the 1095C, and here on slide 5, we're just giving you a sort of screenshot of the 1095C. With your materials, you should have gotten an actual copy of the Form 1095C and 1094C, and I'd say that it's worthwhile to go ahead and have those handy. They're much easier to read than our screenshots, but the screenshots are hopefully helpful. So one area that we've seen a lot of questions on is COBRA, and I'm now moving on to slide 6 here. And with COBRA, one of our questions that comes up is how to go about this, given that there's lots of different COBRA situations. And I have to say, I think that the IRS may have not completely appreciated all the different potential COBRA situations. For example, some employers, with respect to COBRA, will offer coverage for the entire month that the person has a termination event, and the remainder at no charge after the termination event, just to simplify COBRA administration. So the COBRA would really begin the first day of the month following termination, and they'd be covered for the whole month. Other employers will have COBRA occur when the person terminates or the end of the payroll period in which a person terminates. In those situations, you have a slightly different sort of coverage event, I would say, for that month. The IRS has given guidance in 2 locations, and we try on the slides here in COBRA and elsewhere to give a little bit of, here's the source for why we're saying what we're saying. And so you'll see some bullets in here about the IRS frequently asked questions and also the instructions to the Form 1095C, and it tries to point you to where we're getting our answers from so that you can look there as well. And it looks like we might have a question here. So Lindsay, do you want?
Tim, kind of going off what you were just saying, we have a question regarding the contradictions between the Q&A and the instructions for COBRA and kind of deciding which one to follow. So can you just kind of make sure to talk about that, and then also if we should issue 1095Bs for continuing coverage?
Okay, so we can jump into those 2 questions. Up here, you'll see that on this slide 6, for instance, if you go about 4 bullets down, you'll see IRS frequently asked question, Form 1095C Q&A 16, and then it appears contrary to the instructions on page 10. You know, this is where Bob said, if you're not 100% certain, there's probably at least a little bit of wiggle room, because you might have read the instructions one way and then the frequent asked questions say something else. We're telling you here how we think this is meant to work, and if there's a difference, I think you could rely on either the instructions or the frequent asked questions and just point to the basis for why you're doing what you're doing.
Yeah, we like this inconsistency for sort of 2 reasons, one of them better than the other. One is it generates more questions for the lawyers. We're always happy to help. But more significantly is I think this shows that there is a little bit of a mushy standard as to what's correct and what is not here. It gives us some opportunities to justify what we've done.
Yeah. So maybe I'll walk through this slide and then we can talk a little bit about the use of 1095Bs as we go. But the first issue is if you think about COBRA, I try and think about it in terms of 3 periods of time. One is the month in which a person terminates, and this is for COBRA due to termination. One is for the months after the person terminates, they're in the same calendar year, and then one is the calendar year after the year in which the person terminates. So you can sort of divide COBRA and termination into those 3 periods. And this slide 6 really addresses the month in which the employee terminates. In that month, if the employer were to offer coverage for the entire month and not charge a COBRA premium, there doesn't seem to be clear guidance, but it seems like you could continue, arguably, to use some of the codes that they've been using previously, depending on the facts and circumstances. So let's say you had a person who terminated on the 30th of the month, or the 29th of the month, that was 30 days. They're not there the whole month, and they've been code 1A before then. It seems that you can continue to use code 1A for that month because they were a full-time employee. You'd given them coverage. It was minimum essential, minimum value. It would have met the 9.5% of the federal poverty line and everything else. It's just the person wasn't there on the last day of the month, but they had that coverage already paid for. So there's at least some argument that that's an acceptable code there. And in the frequently asked questions going down, let's say that they didn't have coverage for the whole month. That's where the IRS is saying, well, then you still might want to use like a code 1E, a 1D, 1B, 1C, something to show that you made an offer of coverage to them and they elected COBRA. Now, if you look just at the instructions, and that's where this appears a little contrary, on page 10, they sort of say, well, once someone gets a COBRA offer, you start using code 1H. And, you know, in the month that someone terminates, I'm going to skip down to the line 16, you're using a code 2B, and that's to protect the employer from that employer shared responsibility. So I think that if you use code 1H or 1E or whatever, you know, as long as you have code 2B there, you shouldn't be having problems with the employer shared responsibility fee. But that code on that line 14, I think the IRS frequently asked questions are trying to ask or have some way to distinguish someone who has got COBRA. And so that's why they're there saying maybe you should be using like a code 1E or B or C or D. Real briefly here, let's just think through, and we're going to do this on a slide later, but let's say someone terminates in July, on July 29th, and they had code 1E as their code up and through June. They were given minimum essential coverage, minimum value. Maybe it didn't meet the federal poverty line standard, but it could have been affordable. And so they are code 1E up through June. Let's say the cost was $110, and then up through June, the line 16 would be 2C. They elected coverage. They were with you and had coverage. What happens here in this month they terminate July, that line 16 for sure at least is going to change. That's going to be a 2B because they are not going to be, they say even if a person was complete full-time hours, in the year in which, or the month in which someone terminates, you go to code 2B. I'm going to go to slide 7 and now talk about the months after that COBRA termination month.
Can I interrupt you for a sec?
Please.
So 2B, and what do we have on line 14 then, Tim?
On line 14, it would depend on whether or not you offered coverage for the whole month and whether the person elected COBRA and a host of factors. It could be any of the codes listed up above.
Depending upon
the facts of the person's circumstances.
Good.
Yep. So let's say that they terminated still in July, and now we're into how do we report August through December here? Well, in August through December, if they elected coverage, then the frequently asked questions would indicate to use code 1E or the other applicable code. And if they didn't, to use code 1I on that line 14, 1H on that line 14. And again, you can see from the details here as to why we're saying those codes for line 14 in the months after the person terminates. On line 15, you would then list, if you're listing it using a code 1B, 1C, 1D, or E, the instructions are to go ahead and list the cost of the coverage. And so you'd list the cost of the COBRA single coverage. However, if they don't elect COBRA, then line 15 would be blank. And finally, we're down to line 16. And on line 16, we'd list code 2A because this person is no longer our employee. They didn't do any hours of service in that month. And so we're using code 2A there so that we are not having to go ahead and indicate that we might owe an employer shared responsibility fee.
Everybody got that?
I hope. And if there is anything you'd like to go over on these, again, obviously feel free to email a question or comment, and we can take a look and go from there.
And I should just say we are reading the emails as they come in, and we're sifting a little bit because we're not going to be able to get to all of them. But please, this is very helpful to us to have some live, real-time feedback.
Yep. So now we're on slide 8, and let's think about, okay, we're past the year in which the person terminated. And we're going to have to go ahead and, if we have a self-insured plan, we still have to report if the person has elected COBRA. If they haven't elected COBRA, we're done because they don't have any health coverage, they're not our full-time employee, and those are the two criteria that when you're doing a 1095-C, you can always come back to. Was this person my full-time employee for any month in the year? No? Okay, then I don't have a reporting obligation based on that. The next question is, was this person on my self-insured health plan any month of the year? No. If both those are no, you probably don't have a 1095-C reporting obligation on that person. Here, and this gets a little bit to the question about when do I use 1095-B versus 1095-C. You know, in the year after someone terminates, they're no longer your full-time employee, so you don't have to use 1095-C, but I think most employers, for simplicity, at least for system simplicity perhaps, are using 1095-Cs even for people who weren't their employees during the year. And then on the 1095-C, you're going to use a code 1G on that line 14. And you'd indicate that either all 12 months or the number of months that the person was on COBRA for that year, you'd put that 1G. Because on line 15 it says not to go ahead and put an amount unless you use 1B, 1C, 1D, or 1E, that'd be blank. And then line 16 is blank. So that kind of person on COBRA is a fairly easy person. Now, when would you maybe want to use the Form 1095-B? You could use it with this person, and that's another way of avoiding questions about, well, was this person somehow your employee during the year? But it's not necessary. There are going to be some situations we'll come to in a minute where a 1095-B is required because you don't know a Social Security number. But in this case, since they were your employee, you have an SSN on file. Let's take a slightly different situation on slide 9. Oops, I think we've got a question.
Sorry, Tim, before we move on to active employees, for terminated employees, if the employer is using a specific system to produce the 1095-Cs, and they produce the form for terminated employees in 2015, but the system doesn't include COBRA participants at all, will they need to issue 2 forms showing the COBRA coverage, or will they just need to type it into the existing 1095-C? Okay,
and I'll maybe just to repeat that question in my own words here. So let's say you've got a system that doesn't really integrate COBRA well. And so the question is, well, we're going to generate a 1095-C on that person, Tim, who termed in July, but it's not going to list their COBRA information because our COBRA isn't integrated very well with our payroll. What do? The IRS only wants you to issue one 1095-C per employee per EIN. So I think if you had someone who terminated, and if they, you know, what that system is probably going to generate is that for anyone who terminates, it's going to have a default. And its default is likely going to be in the months following termination, it's probably going to use a code 1H, no offer coverage on line 14, and on line 16, a 2A, not our employee. That will likely be the default. If that's what it does, there's an argument that that's totally fine even with someone who elects COBRA based on the instructions, and you can just let that go and be done. So that's likely what the default is going to be on that system. You know, again, you may want to double check and consult with your advisor on this, but because this is just me guessing a bit. But when it comes to the year after termination, though, if you have a self-insured plan, then you're either going to have to manually create those 1095-Cs or 1095-Bs because your payroll system is not generating them. And if it's self-insured, you're still required to show that they had coverage. Yep.
Thank you.
So moving on to slide 9, basically there's a slight difference between if someone terminates And if someone just has COBRA due to a reduction in hours, let's say we have someone working 40 hours a week and they drop to 20 and they're no longer eligible for coverage, in that case, if the person elects COBRA, the thing that's really going to be different is if you go down and look at line 16, then you're going to be using code 2C. And the thing to keep in mind with line 16 is this. The IRS has said if you have an employee, whether they're part-time, full-time, whoever they are, if they've elected coverage under your plan, you're going to use code 2C. And so if the person elects COBRA, even if they're part-time, that's a code 2C situation. Up on line 14, we wouldn't be able to use code 1A because they're not a full-time employee anymore for the period in which they've elected COBRA or had that reduction. So we're going to be using code 1E or the other applicable code. And that's where you would go in and insert the code there, and for the people who don't have that integrated with their vendor, that might then get a little bit more complicated, and they might have to do something where they manually go in and do adjustments as necessary. Another type of COBRA situation that will come up is if you have a divorce or a death or even a dependent who ages off because they're age 26 and is eligible for COBRA. Here, and this is on slide 10, you can use again the 1095B or the 1095C, and keep in mind that we have a note here, you can't use the 1095C without an SSN. So when you've been asking for your employees to get the SSNs of their spouses and dependents and everyone, it's for a very good reason to have that, because otherwise if you just have a spouse elect COBRA, you don't have the spouse's SSN or the child's SSN, you're going to have to use 1095B if you have a self-insured plan. I should note, if it's an insured plan in these COBRA situations, life gets a lot easier for you because it's the insurance company that will be issuing the 1095B in that situation, and you don't, as the employer, then you don't have to worry so much about getting the coverage information right, because the insurance company should be keying off of the information and going from there. If you have this situation where a beneficiary elects COBRA, on line 14, you're going to enter in a code 1G. And keep in mind, that was the same code we were using with an employee who terminated in the year following termination. That code indicates this person was not our employee, but we provided coverage or an offer of coverage to them. So that is what is to be done here. Lines 15 and 16 would be blank. A very brief note about the coverage of adult children through age 26. Employers already know that the Affordable Care Act mandated that adult children be covered through their 26th birthday. Most employers know the next statement, but to some it's still a surprise. Under the ACA reporting requirements, in order to say that you've given an offer of coverage, you have to give the coverage offer for every day of the month. If your plan doesn't cover an adult child through the end of the month when they attain age 26, that creates problems, and that's something you should look at. So just to give an example, the codes under line 14, like code 1A, says minimum essential coverage provided to dependents. Well, if you have your plan cut the dependent off mid-month, you can't use code 1A, or for that matter, code 1E. And that's because you're not making an offer of coverage to that dependent for the entire month. So this is sort of a side note, but if your plan design is such that the coverage of adult children ends the day they turn 26, you may want to revise your plan to see that it extends through the end of the month, because that then comes back to haunt you when you're doing this ACA reporting work.
This is a great example, I think, Tim, of cases where, as people are working through their ACA reporting this year, they're going to have a bunch of yellow Post-its on their desk sort of saying, do we need to change that plan design? And I think, I'm not sure what the dog is and what the tail is, but I think this is tail-wagging dog stuff. There's no universal solution, but when you think through the example that Tim just described, my hunch is you're not exposing yourself to an ACA penalty by much if you don't continue that coverage for that dependent through the end of the month in which they turn 26. So you don't have a lot of risk there. Where your risk might lie is inaccurate ACA reporting. So you just have to sort of make the decision about, do I, tough it out with my insurer or my TPA to change the plan design, or do I, apply the pain to the ACA reporting? And there's no one-size-fits-all, probably.
Yep.
So collect those Post-its as you do your ACA reporting.
So, all righty. Lindsay, do you have?
Can we just go back, I guess, again to terminated employees who
Sure.
elect coverage?
Okay.
We're moving on to who don't elect coverage soon, but if the employee has medical coverage for the full month in which they term, say June,
Yep.
and then for that month, would line 14 be 1E or 1A?
So, let's go to slide 12 because this addresses it, and I think that will be helpful to just give people a look here. And this is again based off the IRS frequently asked questions, because if you're reading through this, you might look at this and ask me about some of these codes, and we'll go over it. So, let's say that you had a full-time employee and they had enrolled in coverage, and they terminate actually again still in the month of July. This slide is sort of tracking that example I provided earlier. So if they enrolled in coverage and they had it all the way through the end of July, either provided or because they elected COBRA, you, at least from the IRS guidance as I'm reading it, I think you're able to continue to use Code 1E in this situation. Code 1A, whether you use Code 1A or 1E depends on the facts and circumstances you have. And 1A, here's what 1A is. 1A is you've offered minimum essential coverage of minimum value, and it's been affordable at the 9.5% of federal poverty line, and the person's a full-time employee. So there's those 4 criteria you have to meet to use a Code 1A. If you meet those criteria except, let's say you just offer minimum essential coverage and minimum value, that's 1E. If you meet those extra 2 steps, full-time employee and also 9.5% of federal poverty, that's when you can switch to using Code 1A. In our example here, we're not saying that we're at the 9.5% of federal poverty, and that means we have to fill in line 15. In this example, the person actually doesn't have coverage through the end of the month. They lose coverage at the time they terminate or at the end of the payroll period in which they terminate, on slide 12 here again. And so you'll see we have 1E for the entire year, and that's because the person elected COBRA and was continuing to get the coverage offer. Now, I haven't in my mind fully worked through how that's minimum value, but again, this is based off the IRS frequently asked questions, so that's the code at least that seems appropriate there. You'll note on line 15 that we have a cost of $110 through June. That was single-only coverage while they were an employee. Once they have to start paying the COBRA premium, you raise that to what's the cost of single-only coverage under COBRA. And it probably would go up to more than $300, but this is just to give you an example that, yes, the price goes up once you go to COBRA. On line 16, you see the biggest changes in a sense. So for January through June, where Code 2C, the person had coverage through our self-insured health plan or insured health plan, they had coverage. In July, we go to Code 2B. And if you read the directions for Code 2B in the instructions, that is covering anyone who is not a full-time employee for the month. It includes someone who terminates during the month, and so that's why we're using the Code 2B there. And then following that in August, so they haven't worked for us at all in August, we're switching to Code 2A at that point in time. So that's how we're getting through the codes here with respect to the person who terminated employment and elected COBRA. We have one more set of slides here I'll just briefly go through, and then I'm going to turn it over to others so that we can get on to some other topics than COBRA. But briefly, if you have a beneficiary on COBRA and you have self-insured health plan, that really means you're probably then triggering 2 1095-Cs, one for the employee, and the employee's one will cover the spouse during the period up to the divorce or death or other things, and then you're going to have a 1095-C for the spouse, because they're making a separate coverage election. And so here on slide 13, we have an example of like a 1095-C for the employee who continues to be an employee. They don't terminate employment. So we've got all 12 months, Code 1E, $110, 2C for line 16. But if you look down at Part 3, the employee is covered for all 12 months while the spouse only through May, and that's because the divorce is occurring in May. And then what happens after that is the spouse will get their own separate 1095C, and they're going to go ahead and be listed down here as getting covered under their own 1095C, and you'll see up at the top on line 14, code 1G for June through December. They're not our employee, but we're providing them with coverage. So that's an overview of COBRA, and there's quite a few slides there. I think that that's one place that's a little bit more complex. Lindsay's going to talk to you now a little bit about expatriates and impatriates and some of the complexities that arise there.
Okay. First, I'm just going to try and address a few questions generally on 1095Cs that have come in. So one of them is if your system doesn't support using code 1A and just has 1E, line 15 the cost, and line 16 2C, is this acceptable? I think and please dive in.
Yeah, I think the answer is yes, but yeah. Go ahead. We can chit chat a little, and Liz, jump in too if you have thoughts.
I think I think because you're already coding line 15 and including the cost, the main kind of advantage for reporting purposes of coding 1A is that you don't have to code the cost of coverage. So some employers have the reverse kind of issue in terms of they can't code the cost and they would prefer to just use code 1A if they meet that qualifying offer standard that Tim talked about earlier in terms of meeting the federal poverty line, safe harbor, and MAC. And so I think, yes, just echoing Bob.
It's funny. This is the third or fourth time this week I've heard this question. So I have a feeling that's how some of the vendors are setting things up. They're sort of defaulting to 1E rather than 1A. And, I'm not sure it's perfect, but it certainly wouldn't justify starting over again.
Yeah.
And then just kind of generally addressing who would not receive a 1095 form, such as owners or individuals working less than 30 hours per week, somebody was asking about, and does not have medical coverage through the company.
Well, I think all those are good points, Lindsay. I mean, if you have, the two touchstones, and anyway, Liz or Bob or others?
No, go.
The two touchstones are, if you have to give it to your full-time employees, so people work 30 hours a week or more, or 130 hours or more in a month, even if they only do that for 1 month of the year, you have to give them a 1095C. And if they're covered under your self-insured health plan, you have to give them a 1095C. So if those two don't apply, if you don't cover owners, they're not an employee, they are not covered, no 1095C. If it's a part-time person, 24 hours a week, they're not offered coverage, don't need to give them a 1095C. Anybody who is in those other two categories, you have to give one to. So if you offer coverage down to 24 hours a week, a part-time person, and they elect and you're self-insured, now you're giving a part-time person a 1095C. Why? To show the coverage. But that carries with it, the IRS still is expecting you up on lines 14 and 15 and 16 to fill in that information, even with a part-time person. So I'd say that the person who's asking a question is in terms of who need to get the 1095.
And I was going to say also that a little bit later on we're going to be talking about directors, which are non-employee directors, and so this conversation will apply when we talk about them too, a little bit later.
Absolutely.
All right, so I'm going to turn to coverage under expatriate plans and coverage for qualified expatriates and how to report that. For the most part, expatriate health plans are exempted from a lot of the ACA market reforms. And so what I'm talking about is kind of pulled from a combination of DOL FAQs, the Expatriate Health Coverage Clarification Act, and now we're starting to see more notices issued by the IRS relating to fees. So I'm going to not talk about those as much because it doesn't relate to ACA reporting. So when we're looking at ACA reporting, guidance tells us that any coverage offered in expatriate plan qualifies as minimum essential coverage even if it's not meeting the ACA market reform, so long as it's a plan that has primary enrollees who are qualified expatriates. Most of the benefits under the plan or coverage are not accepted benefits. The plan or coverage satisfies minimum coverage standards, and it covers dependent children until the age of 26, and also satisfies certain requirements under ERISA, like the claims procedures and requirements. And then the same kind of reasonable good faith interpretation applies to what we are talking about for reporting under expatriate plans and for qualified expatriates. So I keep using this term qualified expatriates. It's kind of defined on slide 16. What we are seeing mostly kind of as questions arise with related to expatriate qualified people is it's usually a company that sends a U.S. citizen abroad, maybe to Canada, for 9 to 12 months out of the year. In certain cases, that individual is placed solely on an expatriate health plan. In other cases, they might stay on the U.S. plan if they have family members that remain in the United States that are covered under that plan. And so you would kind of have to report both ways for that individual. In other cases, you're having companies are having individuals from other countries coming in to work at a U.S. subsidiary. In that case, they're still probably a citizen of that country, but you still may have to report and give them a 1095-C if they're receiving U.S.-based income. So we kind of generally approach this issue as asking, who is the employer in this situation? And then if it is a U.S.-based employer, regardless of that citizen or that person's citizenship, we would still be issuing them a 1095-C. In certain cases, even if the individual is a U.S. citizen and the plan doesn't necessarily qualify as an expatriate plan and they're not receiving coverage from a U.S.-based employer, you still might want to consider issuing them a 1095-C to be on the safe side if they are receiving kind of any type of coverage for their own purposes, because the individual mandate may still apply to them.
Yeah, and we'll just chime in here. On the 1040s, question 61 asks, did you have coverage? And, that would be something where if the person is filing a U.S. tax return, if they have coverage under, there's certain exemptions, and one of those exemptions might apply, and you also have the situation where they might, if they're not in the U.S. at all for the year, and this is such a facts and circumstances area, but they have coverage under the healthcare system for the country they're in, such as Canada or the United Kingdom or someplace, they might still mark the box yes, and it's just that the IRS, when it's looking at everything, it won't have a 1095-C coming in or a 1095-B that says, John Johnson was covered. It'll just be the person on their tax return saying, yes, I had coverage. Now, there's going to be other mismatches like that. There are certain other categories of individuals who are exempt from coverage. If you have coverage through the Indian Health Services or other things, you can go ahead and check an exemption there. So it shouldn't necessarily just trip things up, but it's worth talking to an advisor if you have expats or inpats and just what should we be doing with those people.
Mm-hmm.
Yeah.
In most cases, we're kind of taking the approach of whether or not that person would be receiving a W-2. There are really specific facts and circumstances that we discovered in an earlier session this morning where that doesn't necessarily apply, but that is kind of a general approach that we try to take in first responding to these questions.
So I think with that we can move on to slide 17, and Bob is going to talk to us a little bit about disability and reporting for disability in individuals.
Great, and this has been a question that up until late in 2015 had people kind of in different camps around how it should be answered. I should say, today we're doing this presentation. We did it live in Minneapolis this morning without any call-ins, and today we're going on the webinar. So and on the webinar, I am going to try to hew a little more closely to the slide than I typically do. So the points we have to think about is someone who's on STD or LTD. We'll start with the answer. They will likely be considered still to be full-time employees after they cease active employment, and they will likely still receive a Form 1095-C. So the logic, to the extent there is any here, goes like so. Employees receiving salary continuation are getting paid time from the employer. They're counted as active employees, and that pay means they end up being classified as full-time employees if they were full-time before the leave. If that salary continuation comes in the form of an insured STD or LTD, they're still treated as being paid by the employer. Now, we had hoped and thought that imputed pay would end after an imputed 501 hours due to some cross-references to Department of Labor regulations. The IRS came out late in 2015 with Notice 2015-87 and said, nope, that's not the case. You don't have a cutoff at 501 hours. Now, I'm going to flip to the next slide, but before I start talking about that slide, well, no, actually, we'll just go to it in this slide. So the big bullet point here is that employees out on leave receiving insured disability payments are likely still employed. Now, the practices here vary by employer. The linchpin here is we've got an individual whose employment hasn't been terminated. Some employers will have sort of a general notion of employees out on disability will stay employed for 2 years, and then the employer will make a decision as to whether or not to terminate their employment. Some stay classified as employed for quite some time. Now, if you're in a company where an individual is, once they go out on LTD, they're terminated, then they don't count against you for ACA purposes. And the only reason why you might issue a 1095 to that person is if they're still on your health plan in some way or another. Now, another aspect of this fact pattern is that if the employee obtains their long-term disability insurance from the employer on an after-tax basis, then that LTD payment doesn't get treated as an employer payment, and it doesn't sort of transmogrify into hours. Many employers will provide LTD on an after-tax basis in part because the payments then are received tax-free, and that's a very good benefit for the employee.
So Bob?
Yeah.
Do you think that employers are considering changing their policies based on this particular after-tax provision that you were just talking about, sort of the tail wagging the dog?
Yeah, it's a very good question. I talked to an employer earlier this week that's actually making, having a discussion about that. The tough thing I can say from experience, having been inside, people don't enroll for long-term disability. They often just let it go, and it's a very important benefit. To the extent that employers make it more difficult for employees to enroll, they could see significant drop-offs in their LTD plans. Now, the employer can pay for some of this coverage on an after-tax basis, and that takes the employer out of the soup. The payments from the disability plan would not turn into imputed hours. Does that make any sense? Okay. And I would also say that, if an employer is looking at making some significant changes to their LTD in this regard, talk to your LTD insurer first, because it could easily have implications. Okay, I think we skip over the 1095-C reporting for these facts for now, because it does get a little customized.
Yeah, and I think that way, and we're just running a few minutes behind, we're pretty close to time, so we'll go ahead and transfer it over, Liz, to you to talk to us a little bit about directors.
Sure. Thanks, Tim. So this particular area is somewhat like the beneficiaries on COBRA that we were talking about earlier, because we're talking about directors who are not employees, but who are provided coverage under the employer health plan. And as we said before, you may be able to use a 1095B for the director, but oftentimes people actually want to be using the 1095C just for administrative ease. The caveat with that, again, is that you can't use a 1095C if you don't have the director's Social Security number. So going to the actual form on line 14, you would be using code 1G, because that would be an offer to somebody who is not a full-time employee. And then you would also, if you start looking at the next slide, you would be completing part 3 for the director, including all of the dependents that are under that director, for example, a spouse or kids. And so there's one 1095C for the director and all family members. I was then going to go to the next Davis-Bacon Act or Service Contract Act section, and this is kind of interesting because there had been, at least I had been fielding a lot of questions about what to do with the fringe benefit amounts that employees get if they're subject to these government contracting type laws, and it was especially interesting to find out that at least for this year and for last year, we have some guidance, because what would happen was that employers would be offering employees the opportunity to enroll in coverage, and they would be saying, okay, here's your fringe benefit amount, and you can use the amount to pay for various benefits. And if you don't want to have benefits, you can just get this fringe benefit amount in a lump sum payment. And we weren't sure whether or not that would be able to count for determining whether or not there was minimum affordable coverage and minimum value. So based on the Notice 2015-87, we discovered that yes, those fringe benefit amounts can be used for determining whether or not you have affordable coverage, even if you include this opt-out payment provision. They have asked for some comments and information from various employers to see whether or not they're going to be changing this. So keep your ears open to see whether or not the IRS changes it after this year. Going to the next slide. The fringe benefit payments can be used for the employee for determining whether or not the required contribution, the amount of the required contribution. Now, employers are encouraged to treat these payments as not reducing the employee's required contribution, but they can. And so there may be some sort of a mismatch between what's reported and what is actually paid by the employee. So if the employee's required contribution is reported without reduction, and then you're contacted by the IRS concerning a potential pay or play penalty, you can then show that you are entitled to this relief because you followed what the IRS had asked you to do. And so that's a good piece of information for these kinds of government contracting employers. So then for the premium tax credit eligibility and the individual mandate, employees are not required to take the fringe benefit payments into account as reducing their required contribution. And again, because there can be a mismatch between that, employers are encouraged to notify their employees that they can obtain accurate information about their required contribution, and that they're supposed to be pointed to the employer contact telephone number provided on the 1095C. And we have had lots of employers who are coming up with communication pieces to be sent to their employees to explain to them why they're getting these tax forms that they've never gotten in years past. And I think that that would probably be a good place to put that information if that applied to you.
All righty. Thank you, Liz. I'll just say that not every employer has maybe Davis-Bacon or Service Contract Act issues, but those that have them, that's a very complicated area that Liz, I know, has spent time on and would be a great resource for people to try and work through because things get complicated, especially in determining affordability and affordability safe harbors. On slide 25 here, we've got just one slide in here to try and talk to you a little bit about the idea of W-2 versus 1095-C. And how just because you're doing one might not mean that you have exact correlation between the two things. So for instance, under the rules for W-2s, there's a couple of rules mentioned on this slide, common pay master and common pay agent, where you can actually have a single W-2 issued. With the common pay master, the person might be working at two related entities, and they might get a single W-2. The ACA reporting rules do not have anything equivalent to that. So for instance, and I'll just give this as an example, let's say you've got a nurse and she's working at a healthcare system that has a hospital and a clinic. And normally for 11 months of the year she works 30 hours a week at the hospital and 10 hours a week at the clinic. But then in December she's working 40 hours a week at the clinic, nothing at the hospital. The ACA reporting is done on an EIN by EIN basis. That's how they're going to impose the penalties. So what the IRS says in this case is that nurse would get two 1095-Cs. Even though she's getting one W-2, she gets two 1095-Cs. The hospital would issue one. First 11 months would show her as being an employee and having coverage to the hospital, so line 16 is 2C. Okay? But the last month, she wouldn't be an employee of the hospital in essence, or 2B at best part-time. And then under the clinic, she would be shown in that last month, December, she'd be shown as an employee and covered 2C there. So she's not going to owe the individual mandate because she's got code 2C throughout the whole year. It's just that she's getting two 1095-Cs. And that's something where the IRS basically says if you're working at two related employers, the entity at which you work the most during the month is the one that has the reporting requirement for you for that month. So just a brief illustration of how, this is going to be confusing for employees and employers, I think. The rules for W-2 do not apply exactly precisely to ACA reporting. With that, we're now going to transition a little bit and start talking about Form 1094-C, which is the batching form to send in the 1095-C forms. Lindsay, do you have any more questions maybe before we move on to the 1094-C?
Yeah, do you mind if we just wrap up some 1095-C questions before going?
Why don't you go ahead, Lindsay?
So when we're talking about beneficiary only forms, do we need to include anything on line 14, like we suggested 1G for COBRA beneficiary only?
Yeah, Liz, do you want to take this? So the question I think is if you've got a beneficiary or someone, what do you put on line 14 if they're not your employee? I think this is where, like with the directors, it was sort of like the code 1G is.
I think it's 1G.
Yeah.
Yeah.
And so I think it's on like page 12 or so of the instructions. If you're looking at the instructions, which are generally have at least some good helpful guidance throughout them, they're going to say, look, we understand you've got people like coverage of non-employees is what it's entitled. And
right,
so
it's on page 12 at the top left-hand corner.
Yep. And so for the person asking a question, that's what I would look to in terms of how to report on someone like that.
And line 16 explicitly states that if there's a situation where nothing kind of fits into the code, you can leave that line blank. But for line 14, you need to fill in kind of an applicable code.
Yeah, I'm not aware of any situation where you would leave line 14 blank. I think if you're doing a 1095-C, whether it's for COBRA or for director or for whoever, line 14 will always have a code. Line 16 might be left blank, and that was something where actually the instructions themselves are not very clear on that. But the frequently asked questions on the IRS website, and towards the end of the slide program, we have links to the IRS websites. We'll come back to that, but we have links to the IRS websites where you can find this information. The frequently asked questions clearly indicate that line 16 can be left blank. One question that's come up for all of us, I think, is, well, what if the employee didn't accept the offer of coverage? Can't we just have a code for that? That would be nice and simple. But no, the IRS didn't have something for line 16 for that. That maybe would have made a lot of reporting a lot easier, but they don't have employee decline coverage anywhere. And so you might find yourself, for different reasons, leaving line 16 blank.
Okay. Another kind of follow-up COBRA question is, on the month of termination, if the employee is enrolled with medical coverage for the full month and then elects COBRA, do you put in line 15 the lowest cost premium for self-coverage or the lowest self-only COBRA amount?
If they're a full-time employee, let me phrase it this way. In the month that they actually are in COBRA for the whole month, you are clearly using the COBRA premium. In the month in which the person terminates, I think then you can use, it depends on what your facts are. If you've provided coverage for the whole month and you haven't charged them a COBRA premium, I think you could still use whatever the cost of single-only coverage is, because that's all they were charged for that month.
Okay. And then kind of, I think maybe I'll save, are there special circumstances or reporting requirements for employees who are covered by the Indian Health Service?
That gets a little bit beyond the scope of our presentation here. I think I'd say, I haven't looked in depth at what reporting requirements might be for Indian Health Service. I don't know that there is anything there that would require it, because, again, think about the purpose of the 1095-C. Now, whether or not the Indian Health Service would have any reason to issue a 1095-B, that's a different question perhaps, but 1095-C, in essence, is for employers, and it's about employer coverage. And so I wouldn't think that there'd be any basis that a 1095-C would be issued for that purpose. One thing we could double check on, again, it's beyond the scope a little bit, but I would think that the government would have information on people who are on Medicare or who are on the health service and would know that those people have that coverage. And I know that on the instructions to the 1040, unless I'm mistaken, Indian Health Service is one of the reasons for an exception from having employer-provided coverage. So that's, I believe, how it would be handled there.
And you want to follow up with that one?
We've got an email that I want to respond to, but I'm trying to remember what it's pinging off of.
So we were talking about if it's a COBRA beneficiary only. Mm-hmm. What do we enter for line 14?
Okay, and did we say?
We said 1G.
1G, and we've got an email from a participant who says that the FAQs simply say that the beneficiary should receive a separate form. 1G seems problematic since that indicates they are an employee.
All I can say is that the COBRA in general is a little problematic for the IRS.
Yeah.
I mean, if you look at, again, I think I would point people to page 12 and coverage of non-employees, and what it says here is, let's see here. Here's an example, such as a non-employee director, a retired employee who retired in a previous year, or a terminated employee receiving COBRA continuation coverage who terminated in a previous year. You would then use, this is how you'd report it. It says, if the Form 10C is used, and keep in mind, you could use a 1095-B
yep.
in the situation. If it's used with respect to an individual who was not an employee for any month of the year, Part 2 must be completed using code 1G.
Okay, so there's a great example of sort of a contradiction between the FAQs and the instructions, I believe.
Yeah.
And I all that tells me is that there's some wiggle room here, and I wouldn't omit or refrain from using a 1G because it's inconsistent with one of the FAQs.
Yeah, I think, yeah, I mean, obviously you could contact us later by email or things, and we could talk more about this topic, but the hard thing here is, if you're using a 1095-C, I think the IRS is almost always looking for something in line 14. If you use the 1095-B with this person, the beneficiary in COBRA, there's no line 14.
But it's hard to leave line 14 blank. It's likely to generate questions.
Yeah. Is that our?
We have a question about retiree medical participants. I'm not sure if you want to talk about it here. We can.
Sure. Why don't we? Generally, what's the question, Lindsay?
It's just kind of what recommendations generally for retiree medical participants.
Well, I'll ask everybody to jump in if they'd like to here, but here's what I briefly say. On retiree medical people, here is the guidance as I understand it. If both individuals, let's say it's retiree medical and let's say it's the former employee and spouse, if both are above Medicare age and are on a Medicare supplement plan, there's a regular Medicare supplement plan, no HRA, nothing, just a regular Medicare supplement, there's no reporting requirement.
I agree.
Because they're Medicare eligible, we're done. If they're both above Medicare age and your Medicare supplement is some sort of a health reimbursement arrangement, I'd say it seems there's no reporting requirement, but that's a little less clear than the first one. And then let's say that one or the other is Medicare eligible and the other isn't. So you've got maybe an employee or former employee who's Medicare eligible, the spouse is not. That's when I think you start falling into, you do have some sort of a reporting requirement because one of those people otherwise will not be getting the right 1095 to say they have coverage. And the one other thing I'll say here is more entities have been looking at retiree medical programs that are sort of like a version of a health reimbursement account where they put a certain amount in to pay for the cost of retiree medical coverage. And those HRA type arrangements generally are subject to the reporting requirements. So a general rule of thumb, if both the former employee and their spouse, if any, are Medicare eligible and on Medicare supplement, nothing to do there. On the other hand, if they're both under Medicare, if either of them are under Medicare eligibility age and not on a Medicare supplement, then I think you have some sort of reporting requirement.
Okay.
I think those are good generalizations, absolutely.
Yeah.
Thank you.
Okay. Well, with that, let's go ahead and turn to the 1094, and we've got on slide 26 sort of a version of part 1 and part 2, and then on the next parts 3 and 4. And we're going to go ahead and get into this here. Slide 28 is really just sort of a brief overview, but what we'll do is we'll turn it over to Lindsay, who will start talking with us here about part 1 of the form, and we're on slide 29.
So part 1 of the form is pretty straightforward. We recommend to be very careful filling this out and make sure that the information that you report in this part of 1094C matches the information on corresponding sections of the 1095C forms. So in certain cases, some employers will be sending out different batches of 1095s that will each have an accompanying 1094C. Just make sure that all of the 1095Cs that are, for lack of a better word, represented by the 1094C, this contact information, the name of the employer, the EIN, etc., all matches what's on the 1095Cs. If you are submitting a form as the authoritative transmittal, you'll indicate this in line 19 of part 1 on the 1094C. Yep.
And I'm going to stop you right now because I misguided you this morning when you and I were talking about line 19. There is a case where a single ALE member may file multiple 1094s. So you could have one EIN that operates very differently in different regions or different divisions of the company, and that would be a case where one ALE member files multiple 1094s. One of them has to be the authoritative 1094, and that's when you would check that box. So forgive me, Lindsay, I was wrong this morning when we were talking about this.
I reread it too. Yes, it just goes to show how complicated all of this is in this simpler section. It's still confusing. So yeah, like Bob said, if you have multiple divisions and you say you want to kind of batch all of your 1095Cs for California in a separate, report to the IRS, then you would have a separate 1094C for your California batch. And then if you did a different one for New York, then you would have a separate 1094C for your New York batch, and you would complete all of the kind of contact information in lines 1 through 2 and 3 through 6, 7 and 8, and then if 9 through 16 apply, you would complete that there too. You would indicate in line 18 how many 1095Cs are bundled within that 1094C, and then you would only have to, on one of the two packages, indicate on line 19 that one is the authoritative transmittal. And once one is the authoritative transmittal, then you complete the remainder of the 1094C for that form only. And we'll go over kind of the other parts of that. So, like employee counting and things like that. You don't have to repeat that on both if you don't want to. So that's kind of part 1.
So were you going to call me on my air this morning, or were you going to just pretend like it didn't exist?
I was going to go broadly. Stay broad.
For the record, she didn't answer that question.
Okay. So with that brief note, part 2 consists really of basically 3 lines and a signature. One of these lines is simple, so I'm going to take that one, and that's line 20, which is just the total number of 1095Cs filed by the employer. And if you're a single, let's say you're a single, a simpler entity, maybe you're just going to file one 1095C, one 1040C. You've got 400 1095Cs. You list that up above in line 18, and you list it again here in line 20, and you're good to go. So this is just the total number. Now, if you've sent in multiple batches, as Lindsay was saying, let's say you sent in one of 200 and another 400, here you'd list 600. So this is the total number you're sending in. Bob, would you like to talk about 21, please?
Sure. And my guess is this is old news to many of you. There might be 1 or 2 this year who are going to, get to the end of the year and realize they haven't thought about this topic. So the question on line 21 of Form 1094C says, is ALE member a member of an aggregated ALE group? And ignore the slide for a second and just listen. And my advice is that if you have a controlled group of companies and one or more of them issues W-2s and 1095s, you're going to check yes here. So if you're a control group, generally you're going to check yes. Now I have yet to find the really quick way to go through this analysis, but let me speak to the bullets on slide number 31 relatively briefly. And there's 4 bullets there, okay? So first one, aggregated ALE group is a group of ALE members treated as a single employer under the control group rules. A good way to kind of get your head into this would be to look at the form that you file for your 401k or qualified retirement plan determination letter filing. It will list your controlled groups of companies, okay? And if you have more than one under common control, you have an aggregated ALE group, okay? Now, the next bullet, you look at either your single company, your single EIN, or your collection of EINs with various employees, and if you have 50 or more FTEs in that entire group, you are an applicable large employer. All right? Down to the next bullet. Any member of that applicable large employer group with at least one employee is an ALE member. So here, the 50 employee requirement goes away. Once you determine that the control group, which could be just one entity or it could be multiple, has 50 or more FTEs for the year, then each member of that group is an ALE member. And if you have more than one ALE member, you're going to check yes on line 21. How did I do? Did I keep us in time, Tim?
You're perfect.
All right.
So line 32 or 22 here, this is a little more complicated line, and it gives you the option to check none, one, or more. And I have to say, some of these things, to me, they still are a little bit confusing. So the first thing I would say is if you've already started looking through this and you've checked any of these boxes, if you're sure they apply, that's great. We have no problem with that. Some of these boxes, though, make us wonder a little bit about what the IRS is getting at on some of them. Yeah, I'll just leave it at that. But let's go through them. Box A. So there's 4 boxes. The first is qualifying offer method. If there's even one employee you have, and you've been able to list them as code 1A on line 14 for all 12 months, you can check this box A, and you're good to go. What does this get you? Theoretically, if you check this box, you're entitled to give that employee and any other employee who's a 1A for all 12 months an alternative report instead of a 1095-C if you have an insured health plan. And that alternative report, the IRS thought was, well, if it's a bit of a crunch, they can't get the 1095-C done. If it's an insured health plan, maybe this will help them. I haven't found clients yet who really have found this to be a helpful alternative. And in part that's because, you still have to produce the 1095-C to give it to the IRS. It's not that you're out of the 1095-C. It's just that you've gotten a delay with having to get it to the employee because you've done this alternative. Instead, you just have to produce it for the IRS. So I guess I would check this if you have one employee who's code 1A for all 12 months. If for some reason you fail to check it, I don't know that it'd be a big deal to the IRS, but if you have someone who's this code 1A all 12 months, then you could check box A. Box B is similar, but it's a little more complicated because they're basically saying, well, I've got 95% or more of my workforce for at least 1 month of the year is code 1A. And here, again, it sort of opens up the opportunity to do that alternative reporting, again, only if you have an insured health plan. I don't know that anybody much has a need to use this unless they're using the alternative reporting. I don't know that it really changes much of anything. I think if the IRS saw the box marked, that would indicate that you probably shouldn't be subject to the employer shared responsibility fee penalty. And if it's applicable, that's great. But I don't know that failing to mark the box harms you that much either way. It's sort of a funny thing. And so the most important thing would be is if you're marking this box, you'd really want to make sure that at least 95% of your employees had that code 1A for one or more of the calendar months of the year. Box C in some ways is the most straightforward. It's also maybe the most unlikely to be used. There's 2 different reasons you check box C. One is called small employer relief. So let's say in 2014 that you had 50 to 99 full-time employee equivalents. You are potentially under the transition relief then exempt from the employer shared responsibility fee, not the reporting, but the fee for 2015. And if you want to claim that exemption, you'd mark this box C and say, hey, I only had 80 full-time employee equivalents, for instance, in 2014. I'd like to get the exemption from the employer shared responsibility fee. Now, the funny thing is, of course, if you've offered coverage to your full-time employees and stuff, at least 70% of them, you're not going to be targeted by that fee anyways. But if you're looking for the exemption, that would be one of the 2 reasons to mark this box. The second one is penalty reduction relief. So for 2015, the IRS said, normally we're only going to give you, we're going to exempt out 30 employees. When we're counting up the big penalty, let's say you didn't cover 95% normally, 70% in 2015, we're going to give you a 30-person exemption in terms of calculating that big penalty. Well, for 2015, it's actually 80 employees, and if you check this box, you can say, hey, I'd like to get that 80-employee exemption. What that's really telling me, though, is, hey, this employer violated the rules and owes an employer mandate. And so I don't know how many employers want to raise their hand and say, geez, IRS, I guess I goofed up here. I didn't cover a sufficient number of my employees. Please impose the penalty, but be so kind as to give me the relief for those 80 employees. If you know you're going to be found, I guess there's no harm in checking the box, but it is kind of like raising a red flag if you're checking it for that second reason. And Lindsay here will talk a little bit more about how that plays out in the part 3 of the form. Finally, box D is 98% offer method, and that is you have given minimum essential coverage offers to at least 98% of your full-time employees and their dependents. The relief that you're granted if you check this is on part 3. I sort of overlap into Lindsay here, but she can get into this a bit more. But it's on column B. Normally you have to fill out month by month how many full-time employees you have, so the IRS can then take and compare the 1095-Cs that it's getting from you with how many full-time employees to say, Did they cover 70% this month? Did they cover 70% this month? And that's for 2015. In normal years, did they cover 95% this month? Did they cover 95% this month? And they're doing this comparison, okay? So they need to know your full-time employee count on a month-by-month basis to do that and to compare the 1095Cs against your full-time count. If you can say and prove that you offered it to at least 98%, the IRS is saying, then you don't have to go through and give us those monthly counts of full-time employees. Now the thing about that is, if that helps you and you can say it, I have no problem with you marking box D, but my one qualm or concern ends up being a little bit, is this going to be something where the IRS then maybe has that as a special audit item? Because if they don't have the full-time employee count, they've got nothing to cross-check against. They're taking your word that you covered 98%. So I've got a few clients who have offered coverage down to, say, 20 hours a week or 24 hours a week, and it's very difficult for them to be sure they're getting the right full-time employee count for 2015. But they've offered coverage to everybody, basically, and since they've done that, they want to claim this. I am totally fine with that. If that's the reason you're claiming it and it's difficult then to get those full-time counts, that's one of the reasons you'd want to mark that box D. But just to keep in mind, if you mark it, at least the IRS may have a little more reason to say, well, should we review this? So just a word of a little bit of caution if you're using that, to be really certain that you've made full-time, or to 98% of your full-time employees, each on a month-by-month basis, you've offered minimally essential coverage to them and their dependents if you're marking that box. So that's sort of line 22. At the very bottom of that 1094C, there's a signature. And you'll see at the bottom of the page, it will say, under penalties of perjury, I declare that I've examined the return and the accompanying documents, i.e. the 1095Cs, and to the best of my knowledge and belief, they are correct and complete. Now, here's the thing about that penalty of perjuries. Penalty of perjuries can bring both civil and criminal penalties. We don't think anybody's going to get the criminal penalties for sure, but it does give you at least a little reason to try and make sure you're doing the best you can when you're responding on these 1095Cs and 1094Cs, because somebody, the CFO, the treasurer, somebody is going to be signing this form, and you want to feel fairly confident when you're signing it that you've gotten it completed to your best of your abilities in terms of being accurate. So Lindsay, would you like to take us into part 3 here a little bit? And
I'm going to interrupt her for just a second before she starts. Those of you who are Twitter users, we'd encourage you to follow us, and the handle is at Dorsey Erisa, DORSEYERISA. Follow us if you're so inclined, and take a look at our blog, which is DorseyErisa.com. I was just looking. I think we put sort of a form memo up on the site a couple weeks ago that employers might be able to use when you're asking someone for your signature, sort of a here's what we've done and please sign here. And we're always looking for suggestions for content there as well. All right, Lindsay.
Also, Tim or Bob or Liz, I have one question on part 2 of the 1094C, is its relation to the 1095C. So can you check A for the qualifying offer method in line 22 if you did make a qualifying offer but your vendor, for ease of administration, entered 1E on the 1095C?
I would say no, do not check that box, because the IRS will be cross-checking, is there one employee who has 1A listed for all 12 months? And if not, if it's always going to be 1E, because that's just how your vendor has it set up, I would not check box A. I'd leave you. There's nothing wrong with leaving line 22 blank, as far as I know. So you don't have to check any of the boxes.
Thank you. So now we are in part 3 of Form 1094C and slide 37. So this is kind of that column piece of the form, and it starts out with line 23, all 12 months. So as you can kind of see, we have column A for minimum essential coverage offer, column B for full-time employee count for ALE member, C for the total employee count, the aggregated group indicator in column D, and then any section 4980H relief in column E. So you can check for any of those columns. If all 12 months apply, you can indicate that. In line 23. In certain cases, the IRS expects information like the employee count to vary month to month. So don't feel obligated to kind of enter codes in all months for all columns if you're having a various employee count. You don't need to kind of use your line 23 practice across the board. And then I'm just kind of going to quickly run through, because I know we're running low on time, the different columns. So for column A, we're talking about minimum essential coverage offer indicator. For this year, if you're offering coverage to at least 70% of your employees, you can check for 2015, you can check column A, and then you would have to show a corresponding code in column E. And if you're an if you're an ALE member that's a small employer, you can also check this box if you offered coverage or you didn't offer coverage to 5 employees or less. So you can kind of pick this 70% or less than 5, and whichever one kind of favors you applies, because the IRS does understand that for ALE members, this can be hard if you're small. And then for column A, you don't have to count the number of employees that are on a limited non-assessment period. This rule also applies to column B, the full-time employee count. And then I'm going to move over to column C, the total employee count for the ALE member on slide 36. And this is where you will need to count the limited non-assessment period employees. This is also kind of tricky because you have to choose a day. The IRS kind of gave us a list of days that we can pick from each month to kind of make this determination, and you do have to stick with this day for the entire year. So first day, last day, 12th day, the first day of the first payroll period, the last day of the first payroll period that starts on the month. So pick your day and stick with it as you enter your count. For column D, this is relating to what Bob was talking about earlier with the control groups. If you are a member of the group, then you indicate kind of which months you were a member. This might be an instance where you might check line 23 for all 12 months. This will vary if you're going through mergers or acquisitions. So this is kind of where you would indicate that on the 1094C. And I know that also raises questions for the 1095C, which we'll be covering later. Liz will cover mergers and acquisitions soon. And then for the column E, that's just kind of which code, if you are kind of relying on the relief that Tim mentioned, if you're small, you would enter code A. If you're large, you would enter code B. And now we're going to move on to part 4.
Great.
Okay, so this is the last bit of the form that we're going to talk about today. I'm sure everybody's excited about that, but this is part 4, where you need to list the members of your aggregated ALE group and their EINs at any time during the calendar year. They've only given us space for 30 members, so if you have more than 30 members, you're supposed to take the 30 that have the highest monthly average number of full-time employees for the year and start the biggest and then go down in descending order. Lindsay talked a little bit about these other bullet points here, so let's move to mergers and acquisitions, which will have an impact on who your ALE members are during a calendar year. And unfortunately, the IRS hasn't issued any guidance as of yet. So we're working on a good faith standard to determine sort of how we're supposed to be reporting employees and employers in an ALE group. So it's going to be really very, very facts and circumstances based on your deal. If you have an asset deal or a stock acquisition, whether or not the acquired entity was an applicable large employer, i.e. had 50 or more full-time employee equivalents before the acquisition, because they were going to have to report anyway. But then when they came into your control group, and all of a sudden have 50 or more when they didn't before, that will have an impact on how you report. Also, whether or not the buyer assumed the health coverage. If there was an asset acquisition, there may not have been coverage that the buyer would have to report if it was an asset acquisition, but if they had a stock deal and you actually bought the company, then that company is sort of probably your responsibility for reporting for the whole year, unless you agree to something else in your merger and acquisition document. And which brings me to a point, which is when you are working on a merger and acquisition, most of the time until now, I think a lot of attention has been paid to retirement plans and maybe multi-employer plans or defined benefit pension plans. But this particular ACA reporting and the pay or play penalties are really going to be very, very important going into the future. And so we really need to start thinking about, when you have these deals, what kinds of reps and warranties you want to put into your acquisition documents to make sure that you have assurance that there is not a huge pay or play penalty that you might be stepping into for months before the merger or acquisition closes. This is kind of like, I don't know if anybody on the phone has worked with 409A issues, but when that came into effect several years ago regarding deferred compensation plans, that was not on anybody's radar screen when there was a deal, and now slowly but surely that has happened, and people are always looking out for those kinds of issues. Similarly, pay or play penalties and ACA reporting will be a new topic of conversations in your due diligence and in your documents for mergers and acquisitions.
Perfect. Well, we're just about out of time here, but we do have slide 41 here, which gives you some points to go and look at for things. With respect to the forms and instructions, we've got the websites here for those, and also for the frequently asked questions on 1095C and the reporting requirements. We've got a number of frequently asked questions that are at the IRS website that will hopefully help explain some of their thoughts and why, at least as we've indicated in some of the slides, why we think some of the reporting is to be done the way it's to be done. And then because all of us except myself are photogenic, I got my photo on here just because. But anyways, we have our contact information for further follow-up questions. This is our group here. We don't have Melinda and Holly on this call with us, but all of us work on the Affordable Care Act, and all of us can be reached for questions as you're going through. And I think one thing that can be said is you are definitely not alone. One thing that has been found as we've worked with employers is there's lots and lots and lots of questions, and given that this is the first year, the important thing is, the sense we have, I think, from the IRS is you should be working on this, you should be working to try and get it right, you should do your best, but if it's not 100%, as long as you've made a good faith effort to get everything down and report on people, that's what they're looking for. And it's important for both your employees and for you, obviously, to try and do that as well. Lindsay, do we have any other maybe final questions as we're starting to head towards wrapping up here by chance?
No, if anyone wants to send in a final question, now's the time.
Now's the time. Well, while we wait maybe one more minute to see if there's any final questions, I'll just say, on one suggestion I've given clients is this. When you are working on this project, look and pick out what I'll call the 5 hard people. People who have terminated during the year, people you've hired during the year, people who've had life changes during the year, etc. Maybe a COBRA beneficiary who's a spouse. Pick 5 and see if you're using a vendor, what are they producing for a 1095C. If what they produce on those 5 hard people looks right, you should probably feel pretty good that things are going to look right.
Or look a little harder.
Yeah, or you can look maybe one more time, but at least that'll give you a sense, because ideally, depending on your company, and lots of companies have different demographic factors, but let's say 70, 80, maybe even 90% of your people are, full-time the whole year, same status the whole year, same health coverage the whole year. You're filling in that first column all 12 months. People are electing coverage. It's a nice, easy 1095C. It's the ones where you get things like the person who's an expat, or you had an M&A situation and somebody came into your company mid-year or something like that. if you can pick 5 of the hard ones and see how they're generated, and if they look right, that'll at least start to tell you how well things are going to be looking here. We've heard from multiple clients that they've had the painful process of having to go back and manually look at hundreds, if not thousands of 1095-Cs when they've discovered that not all the payroll data got across right, or some programming got done wrong, or something like that. So one small tip is take some small batch of 1095-Cs. I say 5. If you're bigger, maybe it's 10, some number. You look at them and see, does this look like it's being done right? So with that, I don't think we have any other questions, so I think we'll all just say thank you very much for your time and sign off here.
Thanks, everyone.
Thank you.
Bye.